In the year 2000, Enron Corporation was listed as the seventh largest company in the United States by revenue. Its annual sales had hit $111 billion. Fortune magazine had named it America's most innovative company 6 years running. Its stock had risen nearly 90% in a single year. Enron's headquarters in Houston, Texas was a gleaming 50-story tower, and the people who worked there moved with the confidence of a company that believed it had reinvented the energy business. 14 months later, Enron would be filing the largest corporate bankruptcy in American history. The innovation was not real. The revenue was not real. Almost nothing about what Enron had been presenting to the world was real. The fraud at the center of Enron was architectural. CEO Jeffrey Skilling and CFO Andrew Fastow had constructed a system so complex that even sophisticated analysts struggled to penetrate it. The first pillar was mark-to-market accounting, a legitimate practice that Enron had convinced the SEC to allow it to apply to long-term energy contracts. Under mark-to-market, Enron could book the entire projected profit of a contract the moment it was signed, regardless of whether that profit ever materialized. Enron was essentially recording future earnings as current earnings. When the contracts inevitably underperformed, the losses were quietly buried. The books always showed gains. The second pillar was a web of off-balance sheet entities called special purpose entities, hundreds of shell companies with names like LJM, Cayman, and Raptor, which Fastow himself managed. These entities existed for one purpose: to absorb Enron's bad investments and debt, keeping them off the main company's financial statements. Fastow received tens of millions of dollars in management fees from these entities, a clear conflict of interest that Enron's board approved and its auditors at Arthur Andersen signed off on. Arthur Andersen was one of the Big Five accounting firms, considered one of the most prestigious in the world. Its endorsement gave Enron's fraud a veneer of legitimacy that kept investors buying. Inside Enron, the culture was designed to prevent anyone from raising concerns. The company used a performance review system called Rank and Yank. Employees were ranked annually and the bottom 15% were fired. The message was simple: deliver results or leave. Questioning the results was not a viable career option. Jeffrey Skilling surrounded himself with people who called themselves the smartest guys in the room, a phrase that would later become the title of a devastating book and documentary. The culture of arrogance was not just a personality quirk. It was a business strategy. If you believed you were the smartest people alive, normal rules did not apply to you. And for years, the markets agreed. The unraveling began in 2001. A Fortune journalist named Bethany McLean asked a seemingly simple question in a magazine article: how exactly does Enron make its money? Nobody could fully answer. Short sellers began circling. Then, in August 2001, Skilling abruptly resigned as CEO after just 6 months in the role, selling his shares as he departed. By October, Enron had disclosed a $700 million loss. By November, it had revealed it had overstated earnings by over $500 million over 5 years. In December 2001, Enron filed for bankruptcy. 20,000 employees lost their jobs. Thousands more lost their entire retirement savings, which had been invested in Enron stock through company pension plans. Arthur Andersen, caught shredding documents related to the investigation, was effectively destroyed as a firm. The consequences rippled across the entire economy. Congress passed the Sarbanes-Oxley Act in 2002, imposing sweeping new requirements for financial reporting, internal controls, and executive accountability. It remains one of the most significant pieces of corporate regulation in American history. Jeffrey Skilling was sentenced to 24 years in prison, later reduced to 14. Kenneth Lay, Enron's chairman and founder, was convicted but died before sentencing. Andrew Fastow served 6 years. The Enron story is not just a story about fraud. It is a story about what happens when an entire ecosystem of board, auditors, analysts, journalists, regulators becomes complicit in a story that is too good to question. The smartest guys in the room were eventually just the most creative liars. And everyone around them wanted to believe.